So let's make it concise. I know I've got a hard stop at around 11:50, so I want to make sure I'm best use of your time. First off, my name is Troy Eckard. I own a family energy business in Allen, Texas called Eckard Enterprises. I started off in 1985 as a licensed broker, and I worked with high net worth investors who had a desire to directly own oil and gas interest in wells and different energy asset classes. Most of it was prepared and invested as a result of needing tax write-offs. So I've spent my whole career in the energy space. I've been doing this 37 years. And essentially over the last 3 decades, I eventually owned my own investment firm for 22 years. I no longer had brokers as of 2009, so I didn't need that investment firm any longer. I then started building an internal energy asset management company, mainly made up of a family office. So basically I have my son working for me, my son-in-laws work for me, we're a family business. We represent right now about 750 high net worth clients who are $5 million up to $1 billion in net worth. And all of our clients are interested in direct alternative assets in the oil and gas industry. They either want to be in pipelines, mineral rights, drilling ventures, et cetera. The predominant focus for us is always looking for assets that create cash flow. If there's tax advantages, that's great. That's kind of an added benefit. But we do it in either joint ventures, direct ownership, and sometimes we'll do it in LLCs. We try to stay away from what I call a special purpose vehicle, or we don't like K1s. We don't like this big aggregation of oversight and management. So we do everything pretty much directly. Having been in the business as long as I have, I've seen the industry evolve enormously over the last 37 years. And at the same time, I can tell you that the opportunities have gotten better because the risk of energy has gone down 90% or more. What used to be super risky 20 years ago now is extremely low risk as a result of technology and software. As a precursor to what we're going to talk about today, I have always been an investor in my own assets. So when I started out in my 20s, I would invest dollar for dollar, my own money in the same investments my clients did. And that evolved over the years where probably in every single project I do now, I'm probably the first investor in. I probably had the largest percentage of ownership in each investment class. And that really is the way I like to lead. I like to lead with my own money. We'll buy assets, we'll participate, then we invite our high net worth clients to join us. So just want to make that kind of obvious to everybody. We're in Allen, Texas. Most of our assets are either in North Dakota in the Bakken Trend, Texas, or we have a tremendous foothold in the Oklahoma Anadarko Basin where we've been the last 4 years. So we're very well diversified. We're very well exposed to the industry. I'm on the board of directors and the second largest owner of a pipeline company called Connecticut Partners. It moves 27% of all the natural gas in the Gulf of Mexico. It's a venture I started in 2009. And it's about 70 personal clients. And one of my clients who's a billionaire, we own the second largest pipeline in the Gulf. So we got a lot of exposure, been around a long time, have my fingerprints on file with the FBI since 1985 when I became a licensed broker. I've never had a violation. I've never had a complaint. I've had one lawsuit with an investor in 37 years. We ultimately ended up beating them in mediation because they stole my proprietary data. So from the standpoint of credibility, I'm easy to check out. And it's very good for me to realize that as an investor myself, you have different asset classes, but there's always that concern, the character, how unscrupulous people are, et cetera. So we spend most of our time educating, informing, and being very transparent because you don't know who the idiot is on the other side of the Zoom. You don't know what they're going to do, and you don't know how you're going to get skinned if you've never played the game before. So from that standpoint, it's really, really important. I think at this point, what I'll do is I'll go through what mineral rights are in a very basic 101. This particular PowerPoint I use for basic 101, and then we'll open it up to Q&A, and there'll be 1,000 Q&As. You're not going to get to them today, but I want to try to make this as simple as possible. So I'm going to start off with this little description so everybody knows. There's 3 rights in real estate in the United States. We're one of the only countries in the world that allow individual investors to own mineral rights, the rights to natural resources below the surface, okay? So in the US, when you own a piece of land, if it has not already been separated, you get air rights, you get surface rights, and you get mineral rights. Air rights are everything above the ground that doesn't connect to the surface. Surface rights are anything attached to the surface, buildings, structures, et cetera. And the mineral rights are everything below the surface where you have to turn over a blade or a shovel of dirt to get to it, okay? Because the United States has those 3 rights, you're actually able to sell them as separate deeded titles pieces of real estate. It is real estate. So just like I own the building, I don't own the building, but I'm in the building right here. Whoever owned this building originally, if there was not any severance of ownership, they actually own the air rights above and they own the mineral rights below me. The problem is the mineral rights here are not very valuable. If they do have oil and gas, if they do have natural resources, you can't get to it because we're in the city of Dallas, right? But on the other side, because of the oil and gas industry's acceptance of technology, using the same kind of technology that they send spacecraft to Mars, we've gone from about a 60% exploration failure, 60% of what we drilled was dry holes back 15 years ago. Now it's about 99% or higher success rate, all because of technology. We have really low risk wells, massively big wells compared to 15 years ago. We now have oil and gas basins that have been discovered because of technology that covers essentially 30 states across the US. So this industry went from being completely on its back, almost completely out of business basically in 2008, to now it is the #1 oil producer in the world. And we have essentially 100 million mineral acres that are sitting on top of enormous amounts of oil and gas reserves. So it's changed. High risk to low risk, not very many opportunities to an abundance. Now it's like going to a large prime rib steak buffet. I'm hungry, but I can't eat it all. So what do? I want to go for the prime rib and the lobster tails, and I can forget the salad. So I'm going to walk through minerals, do a little presentation. Anytime anybody wants to come along, Jim, I'll let you jump in and stop me if somebody has a question that's relative to a slide. I always drink 2 cups of coffee in the morning. I grew up in South Texas. You'd think I was from New York because I talk really fast. I was told a long time ago that the human body can hear 300 words a minute. It was my job not to waste your time. I will try to slow down, but coffee does that to me in the morning. This is all natural. I don't drink. I don't take drugs. I just love life. All right. Believe me, I'm probably the most blunt guy you'll ever meet, but it is what it is, right? You just deal with it. Okay. So first off, just to remind you what I recapped is that it's all rights pertaining to what's below the surface. So you can actually have a mineral owner that owns a 100-acre farm. He keeps the cows and the hay, and you own the mineral rights. That surface owner cannot stop you from developing the oil and gas rights underneath the ground. But I also can't walk across his farm because I don't have any rights to the surface. So what you'll find across Texas, Oklahoma, North Dakota, Ohio, Pennsylvania, all these big oil producing states, somebody owns the surface, somebody owns the minerals. Sometimes they own both, but they're both 2 distinct real estate classes of assets. I just want to make sure we keep our mind clear on that. We do not own anything on the surface. It's only below the ground. And I don't need to get on their property. I need a horizontal well to drill underneath their property legally to harvest the minerals and oil and gas revenue that I might get from the property. It is real estate. It is recorded in the courthouse. So if I have a seller on a 100-acre farm that wants to sell me their 100 acres of minerals, we'll do a real estate transaction. We'll clear the title. We'll close. I'll file the deed in the courthouse. Now the courthouse has a record. He owns the 100 in surface. I own the 100 in minerals. It's 2 separate deeded properties, but I have deeded recorded property. You can do 1031 exchanges. You can invest in your self-directed IRA. All that is exactly what can be done. So it's real estate. You own all rights to all natural resources. I don't care if it's gold, metal, precious metals, oil and gas, water, all that falls under the natural resources. We own the mineral rights from the surface below it all the way down to the core of the earth. So I don't care how deep they drill, it's my rights. I own 100% as a mineral owner of all the oil and gas and natural resources. The way it works is, in the oil and gas space, is Exxon, Chevron, any oil company can come knock on your door and say, hey, I would like to lease your minerals. And by leasing those minerals, we want the right to develop all oil and gas or all exploration or all extractions going forward. It normally starts off with an agreement for 3 years. They pay all the lease payments upfront in cash, and they agree to 2 things, the cash payment and the terms of the lease, which says, Troy, you're 100% of the mineral owner. We want to lease your minerals. We'll drill a well within 3 years. If we don't, the lease expires, you get it back. You can release it to somebody else. Or if we drill a well inside of 3 years, we now have the right for future development in perpetuity. We get to keep developing as long as we drill and as long as there's commercial production. The second component is a royalty percentage. The oil companies will negotiate with the mineral owner and let you know, Troy, you don't look too smart. You got a bad eye and you look like you're not smart enough to get out of a hailstorm. We're going to give you only 12.5% of future royalty, and we're going to keep 87.5%. Okay, I don't know what I'm doing. I'll take that. Or Troy's brother's really, really smart, and he says, well, I'm going to take 25 to 30% royalty, and you can have what's left. And whatever the oil company negotiates in royalties is what they have as far as their share of the income. They pay 100% of the cost. They take all the risk, all the liability, all the capital exposures, all future expenses goes to the lessee. And you and I as mineral owners, we sit here free of any risk, free of any liability, and we sit here and get our percentage of royalty, whatever we've negotiated. That's between 12.5% and 25%. That's generally the range depending on where you're at. So we have no exposure to environmental risk, no drilling risk. We sit back like kings. We just get a royalty payment, and we get paid every single month for every barrel of oil and every molecule of gas that's extracted from the minerals that we own. All right, let's keep going. All right, so what I want to remind you is, because it's very important, this is one thing I love about minerals against, let's say, other real estate asset classes. There's no capital risk. I don't get a bill for a sheetrock repair or a hot water heater going out or a storm. As a passive royalty owner, no matter what happens with those wells, no matter what happens in the oil and gas industry, as long as they sell any oil and gas off my minerals every 30 days, the sale of that oil and gas comes to me in a check without any deductions for expenses. Now, we'll pay production taxes to the state. That's normal. It's whatever, 5, 6, 7%. But other than that, I don't get a bill. I've had minerals for 30 plus years. There's no bills. I'm also above bankruptcy. And the reason why I'm above bankruptcy, in the lease document, the oil company assumes fiduciary duty to manage that asset. Part of their management is when the gross check comes in from the oil buyer and the gross check comes in from the gas buyer, they'll take the percentage of royalty they owe us, they set it aside in an escrow account or a segregated account, and that money goes straight out to mineral owners. The balance of the money that they get for leasing the property goes into their account. Now they deduct expenses and bills, and that's called net revenue, meaning net of expenses is what they get to keep. So we don't have to worry about bankruptcy. We don't have to worry if they sell the minerals, the oil wells 50 times to 50 new buyers. It does not affect us. We get a check every single month. All right. This is what it looks like, ladies and gentlemen. We have wells being drilled in the state of Oklahoma, Texas, North Dakota, Pennsylvania. And because of technology, instead of having this thing look like a pincushion, they'll take a single drilling rig. They'll have about a 3 to 4 acre gravel pad site. They'll drill it down. They'll go horizontally out 2 miles. And what will happen is that particular reservoir, based on one well, will pull out a certain amount of oil and gas. The reality is these new buried Grand Canyons are so big and it's such tight rock, a single well the size of a paper plate going out 2 miles can only drain maybe an area 300 feet away from the wellbore. So what they're doing now is they've turned it into a manufacturing process. They'll set 3 rigs like this. Rig number 1 will go out to the south 2 miles at 8,200 feet in depth, and they'll go out 2 miles. The rig next to it might be at 8,400 feet in a different zone. It goes out to the north 2 miles, but it's 4 or 5 wells and vice versa. It's like stacks and layers, and I'll show you in a second. So what happens is we as a company, Eckard, most companies don't do what we do. What we do is we take a complete analytical analysis of what they're drilling, why they're drilling, commodity prices, who the oil company is, what their capital base is. And we've created a team here over the last 4 years that probably is second to none in the country on mineral acquisitions. And our objective is to use 37 years of my drilling experience as a lessee. I was one of those guys drilling to figure out where they're going to drill so we can get under their wells, under their best producers, and we don't have minerals that are just sitting there not activated. So when you see activation, you can own the best minerals in the world. If somebody doesn't drill a well, to me, they're worthless. The only way I make money on minerals is somebody drills a well, produces oil and gas, they give me cash flow, and they give me my reserves, which are now proved reserves that I can go sell those reserves, and those reserves increase my value. All right. This is what it looks like in the US. Everything you see in pink and light pink, this was not here 15 years ago. These are all now shale basins that have become massive oil and gas reserves for the United States as a result of horizontal drilling and frac technology. And so horizontal drilling has made this hard, wet concrete rock, which is a shale formation. It has now allowed it to produce because we've exposed it to 2 miles of a wellbore, and we inject sand and water and crack that rock up like jackhammering your driveway. And what it does allows those oil and gas molecules to produce. So a well that was a great well 15 years ago that might do 100 barrels a day is a stripper well compared to today. Today, these wells are making 800 to 3,000 barrels a day. Wells that used to make 100,000 barrels of oil in reserves, now we can make that in literally 60 days. So the whole game has changed. It's more expensive, but the reward is huge. We used to drill 60% dry holes. Now we're drilling 99% success. So here's your 100 million acres of oil and gas reserves in the US. The question is, which end of the buffet do you start? We prefer Texas and Oklahoma. It's closest to the Gulf of Mexico, closest to the refineries. It's closest to all the pipelines and infrastructure. And the other side of the coin is it's the two most oil-friendly states in the United States, Oklahoma and Texas. So I don't care about what Biden says. I don't care about his federal mandates. I could care less about all his pressure. This is all private land, not government land, in the two strongest oil and gas supporting states in the country. So I'm not worried whatsoever about what Joe Biden says. This is what it looks like underground. It's a current Grand Canyon buried, and that current Grand Canyon has layers and layers that were deposited over 100 million years. Each one of those layers holds millions, if not billions of barrels of oil, and they're using horizontal drilling to come down and drill in each zone one at a time to deplete it. This is what it looks like from a schematic. It looks like almost like a large swimming pool. Everything that's shallower has oil and gas, but it's like not cooking your noodles. It's like al dente noodles. I didn't cook them quite enough, right? The deeper you go, the closer to the magma, which heats it. It's like a pot of rice. It cooks it more. So the deeper you go, it's more expensive, but the molecules are higher pressure. They're more compact, and they allow you to produce more reserves. So somewhere between $45 a barrel and $300 a barrel, we're going to move deeper in the basin and drill deeper wells. The oil companies will, not us. And that just determines how much oil and gas reserves. So you'll find that the industry fluctuates between lower expensive wells, which have smaller reserves, and much deeper, more expensive wells that have much bigger reserves based on commodity prices, which is why we always focus on commodity prices. All right. This is what it looks like underground. It's a schematic. They basically start off in the center. If you see my mouse, you'll have the pad sites. They'll go down, and you've got a whole pipeline. It's like an upside down condo complex. They're going down and drilling wells in all different directions. It leaves virtually no footprint on the surface. But underground, we have all these pipes drilling through all these formations, pulling out hundreds of thousands of barrels of oil per day, and it just creates opportunity. Why is this schematic so important to you and I as mineral owners? If I buy minerals anywhere in that 1,280 acre tract in Oklahoma, I have the right to my share of whatever's produced from the 1,280 acres. Why is that? Oklahoma decided back in the land grant days, they said, here's your horse, here's your flag, go put your flag in the ground, and you get your 1 square mile for coming here and settling the state. But we're also going to make the state completely segregated by square miles, 640 acres. If you're anywhere in that 640 acres and somebody drills a well, you get your share of it. So if I own 64 acres of the 640 acre square mile, I get 10% of all oil and gas and all natural resources pulled out of that square mile. I don't care about the depth. I don't care which side of the property it's on. I get it. The oil companies got smart, though. They said, we can drill a vertical well and go 1 mile, but we can avoid drilling the second vertical well if we can drill a single vertical and go 2 miles. We just saved 1/2 of our cost. So what's evolved the last 15 years is now they'll drill a single vertical, they'll drill out basically 2 miles. And now you and I as minerals, we just got to find a seller that wants to sell us minerals in that producing unit that's somewhere within the 1,280 acres. And they do it. Why do they sell? I own a 300 acre farm. I can't pay my bank. I need a John Deere tractor. I went through COVID. I'm going to go broke. Well, why don't I sell 30 of my 300 acres of minerals fractionalized over the whole 300 acres? Eckard will buy it. Eckard gets his share. And now I've got 300,000 to maybe $500,000 in cash I otherwise wouldn't have. Doesn't change my farm, doesn't disrespect my family. I still have 270 acres of minerals, but I was able to capitalize on the 300 to 500,000 windfall. I can pay off my bank, buy that tractor. And it happens over and over and over again because there's literally 100 million plus acres, all right? They call it wine racking. Wine racking simply means that just like on that wine rack, each bottle has its own contained volume or capacity, but I can't get from one bottle to the other. So these oil companies have decided that these is such rich reservoirs, when they drill the first well, they prove the reservoir works. They come back 7 years later, which is what we're buying now, proven producing minerals. And what they'll do is they'll drill the second, third, fourth, fifth, sixth well. They couldn't get those reserves without drilling those wells. You and I, as the benefactor, as mineral owners, we want them to drill it like a pincushion. I hope they drill 1,000 wells and they suck it all out in a day and give me my check. Because why? We own 100% of the oil and gas. They're just getting the right via the lease agreement to pull and drill and develop the minerals, and we get our royalty percentage. So I like multiple zones, I like multiple wells, and I like to know this is going to be something that can last 25 to 50 years, which is the length of life expectancy for the wells drilled in shale plays. For real estate investors, just give me a real estate analogy. It's like owning a multi-story condo complex. Each well represents, maybe you have a tenant in each floor. It's already generating revenue. The question is, what would you pay for that building today at a 10% occupancy versus what would you pay for this building if it had a 95% occupancy? We don't want 95% occupancy because we're going to pay ridiculous prices. Now it's a cash flow, it's a cap rate. We want to buy proved producing minerals that have dozens more wells to be drilled, 5, 10, 20 more wells to be drilled, multiple reservoirs, like multiple floors in this building. So what we get is a great cash flow today at today's numbers, but we know we're going to get a second, a third, a fourth round of development 5 years out, 8 years out, 10 years out, as the oil companies continue to develop the oil and gas minerals that they have. Just giving you a simple schematic, this is what it looks like. Pump jacks are on the surface. Once the well's drilled, these pump jacks pull the oil and gas out of the ground, like having a Clydesdale. I like to see as many pump jacks, what they call horses' heads, as I can. Everyone is a representative of cash flow. You're looking at a 4-well pad site. On that pad site at the bottom right, where you see the yellow arrows, that's probably in the neighborhood of $50 to $75 million of drilling expenses per rig. That's probably $300 to $400 million of drilling. Think about in any city you're in now, if you saw $400 million of real estate construction, what that would look like. We're doing this every 30 days. These guys are drilling 3-4 wells over 45, 60 days and continue to move because we have so much acreage to develop. This is what it looks like from a map. This is what my team does. We look at the map. We scrape all the data offline, which was not available 10 years ago. I can tell you what Exxon drilled, how they drilled it, Chevron, Oxy. We didn't have that data 10 years ago. So because of technology, because of scraping, because of aggregation information, we now treat this like a game of battleship. We look at where they're going, what they're doing, and we do things like this. We can see the gravel road ends right here. We can see these pad sites haven't been drilled yet. So we know these minerals are going to continue because when they're building the infrastructure, this might be an Exxon location. The next location could be Oxy, and they're working together to build the roads, connect the electricity, connect the water pipeline. So we use all this data and reconnaissance to know we want to buy minerals right up here because we can probably get them for 30 or 40% lower cost because the rig hasn't moved there. It's pre-development, just like buying real estate that's 1 block away from a brand new Target or Home Depot and you still get it for a good price. It's all about understanding the game of development. So here's a simple summary. I'm about at the end. It really boils down to this. Landlords, that's what we are. We own 100% of the oil and gas in the ground. We simply have allowed the oil companies to lease our property, let them go spend all the money, take all the risk, and send us a check for the next 50 years for whatever oil and gas they sell every single month. I've been doing this since 1985. Okay, these are our companies: Exxon, Chevron, Devon, EOG. Name the top 20 billion-dollar companies. We don't buy minerals under small mom and pop oil companies. One, they don't have the skills to drill it the best. That's my reserves. I want only the best surgeon operating on my minerals. Number two, I need to have a lot of money. I need to have billions of dollars of capital because I want them to go drill 100 wells. I don't need Johnny, who has only $10 million to spend. He'll drill 1 well every 10 years. Doesn't work. All right, when you get down to it, it is the most passive income generating asset class that I know of. And I've been investing for a long time. You get a check every month. When you invest in minerals, it takes about 6 months for the paperwork to be filed, the deed to be filed, the oil company to recognize your ownership. They go back to the effective date. Let's say August 1st is the effective date. Oil company gets the notice in October, November that you've bought it, you filed the deed in the courthouse. They run it through their land department, make sure you own what you say you do. They run it through their accounting department and say, this guy Eckard owns the minerals, but his effective ownership was August the 1st. And from August the 1st to now, we owe him 3 or 4 months worth of checks. About February, we get a check from the oil company. Eckard's accounting team processes, says 40 people own these minerals. Here's your 40 checks. No expenses, no bills. It comes in a nice big fat green envelope. All you know how to do is deposit or let your ACH statement show up on your statement. That's it. Once you get that first check, that is a check every single month. I don't care what the price of oil is. I don't care what's going on in the White House. I don't care about inflation. What I care about is I get paid first before the oil company takes its money. I love the in, I hate the out. This is what minerals look like when it comes down to common sense. Our average cash on cash portfolio right now, we've been focused on minerals for 4 years, is 18.529%. It's going up every single month. Why? We use a very, very low dynamics or parameters inside of our economic model. We're shooting for no loss of capital, a 10% rate of return or better on every single portfolio. We want growth. We want more wells. And fortunately for us, we called it right 4 years ago when we jumped in the mineral market and we put the team together. We're crushing it because instead of 10%, we're getting 18.529 across all portfolios. And if you'll notice in the small print, because I'll get my little video out of the way, some of these portfolios have now done 50, 60% in 12 months, 18 months. And it's just going up because commodity prices are just going to keep going up. And I want to say that's the last slide. And bingo, that's you and I resting on the beach, waiting for that green envelope to show up, because the only thing you have to worry about is the number one question I get, Jim, is going to be, well, how's this so good? This market wasn't available 5 years ago. Billion-dollar funds were brought in from Wall Street. They wasted their money in 2015 and 16. They couldn't tell you which way a drill bit. turns. So what they did is they threw money at it and they bought in all the wrong places. So the capital is gone. Cash buyers like us, we're the #1 buyer of deeded minerals in the state of Oklahoma, have been for 2 years. Why? You clients, you investors aggregating and buying through Eckard, you have become our source of capital. We're the #1 cash buyer in the basin. And it's all because our clients are considered to be our bankers. All right, so that's what I look like on the beach. I've been on the roof for 10 days, so I was afraid I was going to run out of steam and my voice is going to give out, but that just doesn't happen. My wife is waiting for me to get laryngitis, but I haven't had it yet. So questions?
That was great, Troy. We got, I have a few questions, but Daryl jumped in there, so we'll ask his first. How is the income, the cash flow, how is that taxed?
Okay, so what happens is, this is all ordinary income. So what'll happen is you'll get 12 distributions a year and a 1099, ordinary income. There's no tax deductions. However, if you invest directly, not inside your self-directed IRA, 15% of your income is tax-free. And so that's really the only advantage you get, is that you pay 15% less on your gross income. What a lot of our clients will do, Jim, is they'll invest in the minerals. They'll have their income from their businesses, their medical practice, and they'll actually look for opportunities to drill wells in the same areas in which we bought minerals. So it's been kind of a nice compliment. We'll simply do minerals, and then we'll run across leases that we can buy in the same wells we're owning minerals in, and we'll drill the same wells with the oil companies, and that's 100% tax deduction. But as far as minerals, the IRS considers it as kind of like real estate. If my house burns to the ground, the insurance company gives me a check for the house, but I don't get any money for the land. Minerals never go to zero value, according to the IRS. So they give you depletion allowance of 15% per annum.
Okay, awesome. There's a few more questions. How does the promote structure work? Have you had any investor losses, and how many full cycle deals have you completed?
Wow, that's a whole mouthful. So I'm in the drilling business. We probably had an average of 40% dry holes over the last 30 years. I've lost millions of dollars for clients. I've lost millions of dollars of my own money. And what I decided at 54 years old, 4 years ago, is that my risk tolerance, I was no longer the gunslinger. I was tired of having one good well making 10-to-1 and then having 8 dry holes. The oil industry imploded in 2003. That's why oil went to $145 a barrel. When you're asking about how many mineral projects have gone full cycle, they're never going to go full cycle because we haven't sold any. So I don't know if I got all the questions right. So oil and gas is a risky business. Minerals is not like the rest of the industry. Minerals, if you buy them correctly, in my view, you never lose your money. It's just what kind of rate of return you're going to get. The other side is that it depends on when you buy them. If you buy them at the height of the market, it's like real estate. If you buy too high, it's going to take a lot of work to get you to a decent rate of return. Our philosophy is take our model and buy at the right price with the right parameters. And we look at thousands of acres a month, and we probably buy 400 to 500 acres a month. We're extremely picky. As far as the full cycle, our strategy here at Eckard is AML, aggregation of fractionalized assets, mature those assets by letting the oil companies drill those wells and put them online. So we kind of suck the lemon out of the juice the first 4 or 5 years. And then the L factor is the liquidation. Do we sell? Who do we sell to? When do we sell? Why do we sell? Every single mineral that we offer, you're going to own directly. They're your minerals. If I decide to sell half my portfolio in 3 years, every one of you may say, we don't want to sell. We don't want to pay the taxes. We love the income. We have nowhere else to go. Because they're individually owned, we will put out to our partners, hey, Troy thinks portfolio number 5, we should go sell. He's going to sell 25%. We'll proxy, we'll tell you what we think they're worth. You can say yes or no. Doesn't matter. You can sell the same percentage to me or a different percentage. These minerals will not have what I would call a full executable cycle unless we completely divest a single particular portfolio. And I don't know if I answered all those, Jim, if there's one part I missed, but I tried to stay focused.
Yeah, the first part of that was, how does the promote structure work? Meaning, what are the fees and all that?
Well, I was going to charge 150% markup, but I couldn't get away with that. So we decided a fair value was as follows. Eckard goes out and finds the minerals. We've got 3 of the top land companies. We're spending hundreds of thousands of dollars. So we put a 35% gross margin on each mineral acre that we buy on average. Some a little more, some a little less, but across the board, 35%. By the time we take that 35% in, pay our taxes, pay for overhead, we hope to make basically a 10% fee across the board. I take that fee and I buy more minerals with my own money. I'm the largest buyer. So we do it across the board no matter what. The goal and the objective is, if I can't go buy and accumulate minerals and be able to give you as my investor a price per acre or a price per mineral portfolio that's the same or better than you can go buy for yourself in the market, I've not done my job. So far, we have geologists, engineers, lawyers, bankers, guys that are petroleum engineers. They've gone out and tried to find minerals, the quality we have at the price we have. They've all come back and said, we can't find as good of minerals, and we sure can't touch the price you're selling them to us for. So we believe the aggregation of all the capital from our high net worth investors, and because of the way we set it up, our 35% fee is absorbed and diluted because we're able to buy them at or below the price you can go find them yourself. And it gives me a big stick to be able to say, I've got $10 to $20 million a month I can spend because I got my partner standing behind me. This is truly a partnership relationship between our clients.
Excellent. All right. So this one, it says he's not well versed on extraction methods. If not fracking, what methods of extraction and how much minimum land is necessary in the right locations? You've already acquired the land or are acquiring it and offering passive investment only, ? Yeah,
that's a real complicated question. Probably not going to be real good for this particular, there's probably other questions. I'll just answer this way. We don't decide squat. Exxon, Chevron decide where to drill and how big the unit is. I really don't care. What I care is I want to know where they're drilling, where they're producing, and I want to find a seller who wants to sell me those minerals under that property. Without horizontal drilling and fracking, you go back 15 years ago, which is a 7.5-inch wellbore the size of a paper plate. You get a geologist that tells you where to drill it. If you're off by 100 feet, you have a dry hole. That's not the way it is today. Today, I don't even talk to geologists really. What we do is we have this massive Grand Canyon. I got to be somewhere in the Grand Canyon walls, go down 9,000 feet, have an engineer successfully and as best they can navigate getting into that pay zone. And at that point in time, I end up with extraction of a tremendous amount of oil and gas reserves in place. So it's not about the process. And again, I want to stress this to everybody in here. If you've been investing in oil and gas before and never done minerals, all the things you've been trained to ask questions about, location, offset wells, formations, fracking, forget it. We're a tick on a dog. We go where the dog goes. We're buying with Exxon. We're buying with Oxy. We're buying with Chevron, with Devon, EOG, Pioneer. The best thing I'm going to tell you right now is the smartest minds in the world. Every other country hires oil and gas experts from the U.S. to go help them. Aramco, Saudi, Venezuela. And the reason we do that is because we have the freedom of taking a risk and not being executed if we drill a dry hole. So because of that, you and I as mineral owners, we want to buy minerals under those smartest engineers, geologists, geophysicists, financial officers. They control the best price, they get the most pipeline capacity, get the best refining. And all we want to do is buy with those extremely successful companies. And I don't have a clue and I don't really care what they drill or how they frack. I want to buy underneath the best oil and gas companies because they got the smartest minds. We got about a $2 billion payroll that works for us for free every day because they're deciding the best location to drill wells in the United States.
Why don't they buy their own mineral rights?
But I'm having fun. Go ahead, Jim. What?
I'm sorry. Why don't they buy their own mineral rights?
Okay, so think about construction. Real estate is a little bit like this. You're either a raw land developer, you like to go buy that farmland, convert it, entitle it, annex in the city. That raw land guy hates verticals, not going vertical construction. The next layer of real estate says, I really don't like raw land. It's too speculative. I want to buy that commercial lot and I want to build a self-storage, a commercial building. So they're in the commercial land business. Then you have property management who wants to buy an existing fully occupied self-storage. They want to put it in their portfolio and improve it and make income. Oil and gas is the same way. There's three sectors. There's upstream, midstream, and downstream. Upstream are those that want to be involved in the exploration, extraction, and production all the way till it comes out of the wellbore, the well itself, right? Midstream is anybody who wants to be in pipelines, refining, and they want to pick up your gas and oil at the location. They want to move it down to the refineries. That's called midstream. And then downstream is where they want to process, refine it, and sell it to your house or synthetics or your plastics or whatever, right? Only time I ever really see exploration upstream companies get into the midstream pipelines, this goes back to minerals, is when they go, we got a big field and nobody will build the pipeline. Nobody can get financing. We'll just build it ourselves to get our oil and gas. The oil companies like it this way. You and I, Jim, let's say you and I own 1,000 acres and Exxon approaches and says, hey, we want to lease your minerals. Well, they can lease it for $2,000 or $3,000 an acre, and all they got to do is drill one well in 3 years. And they control all future development for a couple of $2,000 or $3,000 an acre. But if they wanted to buy our acres, we say, well, that's $15,000 or $20,000 an acre. They're like, well, I'm not giving you guys $20 million. Okay, why is that? They can lease it for $2,000 or $3,000, and they're going to get 75 to 87.5% of all the revenue to go drill the wells. Or they can buy the minerals and get 12.5 to 25%, but then they got to rely on somebody else to drill it, even if they drill it themselves. So the way the industry's worked out, I only know of one company really that has set up a joint venture where they're buying their own minerals, and that's Continental Resources, Harold Hamm. He did a joint venture with a group and said, you guys will buy the minerals. I'm going to show you my map. I'm going to show you my trailer. I'm going to tell you where I'm going to go drill. You get ahead of everybody else and go buy those minerals cheap. We're going to drill the wells. After they've been online and producing, Continental has an agreement. They get to buy those minerals back from that company. But by then they've made 2 or 3 times their money. So it's a kind of a JV that results in better oil and gas reserves to Continental. Virtually no one else I know of buys minerals in the oil and gas exploration side. They know their sector, they stick with it, and that's what they do, which leaves a massive opportunity for guys like you and us.
Okay, so what do the typical cash flows look like year 1, 2, 3, all the way up to 5, 10 years? And how long does it take before it's full cycle, meaning you get your capital back and maybe you sell it if you do sell it, or you said some you sell, some you hold on forever?
Years ago, because back 10 years ago, the oil companies realized we have 3 years to drill or we lose the lease. Well, they went out and they leased 50 million acres. We didn't have enough drilling rigs. So what they decided is we got to drill a well and move and drill a well and move, or we're going to lose billions of dollars in lease money because they're going to expire. So they would drill a well, complete it, turn it on, go to the banker and said, I just proved these reserves work. Give me some more money. And they just kept doing it, right? So from probably 2008 to 2014 or 15, you had thousands of wells drilled, 1 well per mineral lease. Those wells produced, they came back and said, you know what? We used old technology. They made 200,000 barrels of oil. They're good wells. They paid out, but they're not great wells. Today, we can drill a well 3 or 4 times better. So they're coming back to those older single well units and they're doing 2nd, 3rd, 4th, 5th, 6th wells. What we have the advantage of, though, is that we get to go back and look at all that data and look at who's going to drill. And effectively, back to your cash flow question, when we buy that mineral, we really don't care about the cash flow from that well. It might make 2 or 3% return. What we care about is the oil company's already either drilled 4 more wells, they just haven't completed them. They got a permit to drill 4 more wells, or they got a permit to drill in a different zone. We're buying it in order for us to make probably a 10 to 12% first year cash on cash return. We expect an acceleration in the 12th through 24th month because we know new wells are coming online. And like a brand new 3-liter Coke, when you shake it, it's going to come out like a racehorse, right? When they open up a new well with 3,000 pounds of pressure per square inch because there's been 2 miles of earth sitting on it, that first 12 to 24 months is going to produce a lot of oil and gas. So we like that first 12 or 24 months of production, which accelerates it. So maybe 10% the first year, maybe 17, 18, 20% the second year, 17, 18% the third year. Then it'll decline because these are declining assets because you're pulling out oil and gas. And maybe we level off in years 6, 7, or 8, we're down to 10 or 11, 12%. By then I made all my money back. I have passive income with no expenses, and I got every molecule of gas being sold and I get free income. Then what I'm counting on is the additional 5th or 6th well being drilled. And I'm counting on the 2nd layer to be produced and the 4th layer, the 3rd layer to be produced. And so for me, I'm all about trying to achieve a minimum 10% cash on cash return over 5 years. Don't care if I get 50% on the 60th month or 50% on the first month. I just want to average 10% or better. And then I want all the benefit of that oil and gas revenue and oil and gas sales generating that free cash flow for me. Now, the other thing everybody should know, in our models, we usually use $75 or $80 a barrel, even though oil's at 95 today. We're using $3.50 or $4 natural gas, even though it's at $9.50 today. And the reason why our portfolios have done so well, we use really suppressed economic parameters because I don't control oil and gas prices. So what I want to do is leave you as my partner, knowing I've got this really compressed, super conservative financial model, and Troy thinks I can average 11 to 15% over 5 years, but he's going to be wrong. And he's going to be wrong to the upside. Well, that's great. I don't want to be wrong to the downside. I don't want to tell you 10%, I give you 7, because I don't care if I hit 9.999, you're not going to like me because I was wrong. I like to be right. I like to win.
All right. Well, on that note, what's the hypothetical worst case scenario?
I'm Leo DiCaprio with Catch Me If You Can. I really don't exist. This is a model studio. I'm going to take your money and be in Cayman by this afternoon in my Tommy Bahama shirt. The risk is that I'm either a crook or I'm incompetent. And the thing I will tell you, like you're looking at our current package we have out now, I already went out, bought the minerals, paid for them with my money. And so if every investor today said, we're done with oil and gas minerals, we like real estate markets distress, we're going to go buy it. I currently hold about $20 to $30 million worth of minerals that I've already cash paid for. So I buy them, I package them in a portfolio. I mix a portfolio that we think is going to make the best returns for our clients. And then I say, look, I'm taking 10 to 15, 20% of each portfolio I'm retaining for myself. Here's 80%. So your question is, what can go wrong? I'm an idiot and I'm incompetent. Tomorrow, somebody comes up with salt water as the new energy source and oil and gas is debunked. Price of oil falls at $20 a barrel. Nobody wants to drill any new wells. Well, that means we're in not just a recession, we're in a massive global depression. et cetera, et cetera. So it's the outliers. It's the black swan event. What happened during COVID? Well, COVID was the best thing that happened to oil from my perspective. When COVID hit, it shut the economy down. Russia, Saudi Arabia flooded the market. When they flooded the market, they killed the capital. This industry is void of capital. Biden, everybody's saying, do not invest in oil and gas. If you do, you got to have all these disclosures and carbon footprint and how you're affecting it. So all money's left the oil and gas industry. We're only drilling off the cash flow right now. I love that. I love the barrier to entry to be super high, because those sellers of minerals have nowhere else to go but us, because nobody can get financing. So I got willing sellers. We're one of the only buyers. I'm buying at really suppressed prices compared to what they should be. And what I'm doing is offering it back to my partners with a fee that allows me to cover my costs and put the best people in the field. So how long has this been going? For 4 years. How long will it go? Maybe another year, year and a half. Why? Oil's going to $130 to $150 a barrel. No ifs, ands, or buts. Natural gas at $9.40. It'll probably be $15 or more because of the Russian war this summer. Our model is going to blow it out of the park. But also that means the sellers are going to recognize $130 plus oil. They're going to go up 10, 20, 30% of minerals. We may decide next year we can't find anything worth buying. We're not going to buy. So it is really about, am I competent? Am I the real deal? My CRD number is 2711. I bought the firm in 1991. It was called Eckard Investment Services. My license and fingerprints are on file. All you have to do is go to broker check. I don't know if I'm still in there. It's been so long, right? You can go online and Google Connecticut Partners. You'll see that my partners, the McCombs family out of San Antonio, $2 billion family, been partners of mine 13 years. You have one negative comment about me on the entire internet. It's where a crook in Costa Rica said I was conning him down there because I bought a great piece of property that he wanted and couldn't get. Other than that, I've only had been one lawsuit with one client in 37 years. They were stealing all my proprietary data, $250 million family out of Indianapolis, and I caught them. And I stopped managing their assets for free and said, manage your own stuff since you happen to be a bunch of crooks. And so they sued me, not for money, but they said, we don't know how to do this unless you tell us. Well, I'm not telling you, you're a crook. And so they sued me. I countersued them for $35 million. They settled in mediation. We went away. That's the only thing I've had in my entire career in 37 years. Why? I'm blunt. I hate crooks. I help my clients chase down other people that have scammed them out of money and other investments. I enjoy putting criminals out of business. I enjoy helping investors collaborate. I know it sounds too good to be true. I'm as blunt as you'll ever get. I work like this 24/7. If you don't like minerals, don't invest. If you don't like oil and gas, don't invest. If you want an inflation edge, you want to make passive income, and you want income coming for 25 to 50 years, minerals are the right place. Whether Eckard's right for you or not, that's your choice.
All right. So I don't know if you've answered this yet or not, but for each dollar of minerals extracted, what percent does the oil company pay? And then I think you did answer this part. For the cash paid, how is it broken down? Operating costs, promote, splits, et cetera.
There's no, okay, I'm gonna say it one more time. We charge a one-time fee. There's no fees after that. There's no equity, there's no split. You put $1 million in, you own $1 million worth of minerals. I made my fee up front. We process the revenue every month. There's no management fee, there's no processing fee, there's no back ends, there's no equity. We're partners. You own what you own, I own what I own. Why do I do that? I get $1 million check in from Ovintiv 2 weeks ago. All I got to do is drop the $1 million into our accounting deck, and it says there's 35 people that own it. Everybody gets their share. And I send you a stamped envelope with your check, and in a green envelope, go, here's your check. I don't have to bill you. There's no receivables. There's nothing. So I give you 12 checks or ACHs, and I give you a 1099. I can't get my money till I get your money. So it's pretty simple for my accounting staff. Drop in the gross, give me my check, give the other 50, 100 clients their checks, send it out in a green envelope, and we're all happy. There's no bills. There's no accounting. This is the most beautiful thing I've seen in my entire career. So I love it. As far as operating costs, there's no operating costs. So one of the things our clients have been doing, though, is they love to ask us a lot of questions. A lot of them are taking their self-directed IRAs, investing in minerals, and then they're doing an appraisal, and they're getting a discount before they convert it to a Roth. And the discounts have been 40 to 60%. So they've all figured out we can take massive savings on taxes by taking our self-directed and rolling it over to Roth and getting the discount. They love it. And I believe that is really one of the things that is most important is we're here as a source of information. We collaborate between our 800 clients to help you figure out the best ways to manage your money. So that's kind of one of the hidden values you have. We're the only sponsor, the only oil company, only really real estate that puts all their clients in the same room. We have an annual conference, and we invite all of our clients, small, big, tall, super wealthy, not so wealthy. And we say, we're having a conference. It's 3 days. We'll pay for your hotel. You just get there. We pay for the food. And you get to sit around 400 other like-kind of millionaires and ask questions. Is that Troy guy a crook? Is he on drugs? Does he drink? Is he investing money over to Cayman? And they all ask those questions. By the time they're done after 3 days, it's like this biggest family reunion you ever met, because they're like, this guy's the most real deal there is. And we all know each other. And if he was lying, we'd beat him like a piñata on the third day. But since he's not lying, we're going to become partners for life. And that's what I've had the pleasure of. A lot of my clients have been with me 20, 30 years. Unfortunately, most of my clients are too old or they passed away. So we started 3 years ago rebuilding our client base. We went from 120 clients. Now we have almost 800 clients. By the end of next year, we'll be well over 2,000 clients. Why? Results, 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 results.
What's the investment minimum?
Every portfolio has a minimum of $25,000, except our larger portfolios, because the accounting is more difficult. So on a standard project, we like people to start with $50,000. It's kind of like you can't get in a poker game when you only have a quarter in your pocket. But if you start in a portfolio, if you're only going to do one portfolio, don't invest with us. We build a portfolio of minerals from different areas, put it into one single portfolio. You'll put in $50,000. And then we want you to look at several sequential portfolios, because now you'll be like most of our clients. Now they own interest in 1,400 wells and 300,000 gross acres. So we like to diversify several oil companies, several locations, several wells. The bigger packages like our Lone Star is a $70 million package. We're over halfway funded in less than a week. It's a $250,000 minimum. That particular package, though, has probably 100 years worth of well life and just massive reserves. It took us almost 20 months to get a package like that under contract. So we've offered it out to our clients at $250,000 minimum, and that's what we have currently at this point.
Okay, I know you have a hard stop here in a couple of minutes, so I wanted to give you an opportunity to kind of close up. Is there anything else? I'll take last questions, but if you have anything parting to say, I don't want to keep you longer than you have.
Well, David Day is your wealth manager. He's online with you right now. David is outstanding. He works 24/7. Pretty much David will give you a cell phone number. My cell phone number is 469-422-1781. Now, you need to use David because he's good at what he does. If you have other questions, we have a lot of communication with our engineers and staff. You're our partner. You're not a client. So we want to answer all your questions. I'll be honest with you. Some of you are going to be like some of my current clients. You're going to go into that doctor's office and he's going to want to do surgery on you. And you're going to ask him all the questions about what tools he's going to use and how he's going to do surgery. And it doesn't matter. He's going to put you out and do whatever he wants once you're asleep anyway. You're either going to have to trust us as a successful, honest, transparent oil company and ask the really good questions about financing and self-directed. But if you're going to ask me where I'm drilling and why I'm drilling and what the molecules look like and the gas to oil ratio, you're probably not our client. So we have a lot of engineers, but they've also learned that we're the experts. So what I would wrap up with is the following. We're super transparent, open door policy. You come in our office anytime unannounced, somebody will meet with you. We have nothing to hide. Client communications wide open. Talk to clients, come to our conferences. This is the most unique opportunity you're ever going to find. I can assure you that nobody does business the way I do business, but we're not going to beg you. We're not going to ask you to invest. We're not going to kiss your backside. We're going to lay out in front of you what we do and how we do it. And we're going to work on a financial plan. And if it makes sense for you, we're going to welcome you in with both arms and we're going to treat you like you're the most important client. But I can assure you of this. There is a storm coming in energy, a storm coming. I've been telling my clients for 4 years, I'm like Notre Dame. I've been so accurate. And we are about to see oil skyrocket because of what Biden did on the SPR barrels of oil. Forget all that green energy nonsense. Stop worrying about whether they're going to have EV cars. Unless you're butt naked on a dirt road using sign language, you're using a barrel of oil every day. So from my standpoint, oil and gas is going nowhere except up. And they're not going to stop until we drill more wells. We have no more money. We have no more rigs. Oil's going to $130 to $150 a barrel. Natural gas will probably be $15. This is the asset to be in with raising inflation. That's all I got.
Awesome. Well, thank you very much. I know there's a few more questions, but I will recommend that they reach out to you, Troy, or you, David, to get those questions answered. We appreciate you coming on. This was, fire hose, right? Drinking through a fire hose. There's a lot of information. No, it's great. It's great. I'll watch it again. We're going to put the recording up so people can watch this again and get the information. But David put the contact information in there, so you can contact David if you want. Troy just read out his cell phone number, so you can get that. But thank you very much, Troy. Thank you very much, David.
Last question, Jim, the last question I saw, I just do this as we're parting. We currently have $250 million worth of minerals under management over the last 4 years. We're closing on about another 100 million by the end of the year. The goal is to be at $1 billion worth of cash, non-debt, paid for minerals generating 20% return. So between us and all of our clients, I think by the end of 2024, we'll be well over $1 billion in cash flowing, no debt minerals. So assets under management today is probably 260 million. We're closing on 2 more projects. That's going to put us around 350, 360 million. Again, it's not size. It's about being very surgical in our decisions. So for us, it's just one portfolio at a time. I know a lot of you are going to think about, like financial planning and ETFs and all that stuff. This is different. This is real estate. We directly own it. We're buying just like real estate. I can only find one good piece of real estate at a time. We're taking our time. This is about you. This is about your portfolio, your retirement. So think that way if you can. Thanks, Jim, for having me on. You guys take care. I got a hard stop. I got to go. We'll see you.
Awesome. Thank you.
Yes,
And
sir.
thank you everybody for attending.
Thanks, Jim.
Thank you, David. We're going to close here, and I will we'll have the recording posted hopefully in the next couple of days. But thank you very much again for attending a lunch and learn with Left Field Investors and Eckard Enterprises. Take care, everybody.